Hey, welcome back to the live stream on my channel. It is good to have you. We are enjoying a great stock market. We have stocks going up quite consistently for the last year and really the last couple of years. If you look at the S&P, it's up 33%. We had a down day today with the Dow going down about 0.55%, the S&P down 0.19%, Nasdaq's down about the same. Then the Russell's down about 1.25. So it was a little bit of a pullback on small caps. But small caps are still enjoying a very good year. And if you look at the last 6 months, it's doing really, really well. 16% in the last 6 months. So small caps are really doing well. And I'm going to show you at least one small cap a little later that's doing great. If you have a stock you want to review, please put it in the chat. We'll take a look at it and see what it looks like. We'll do a quick valuation on it, maybe dive a little deep on it as well. Now, continuing on, the NASDAQ, it's doing great. Over the past year, it's up 38.4%. And those technology stocks are just rocking and really giving investors a lot to be happy about. So the NASDAQ, all the indexes are doing well. And so is crypto. Crypto is just having a fantastic year. We look at the year in review, it's up 120%. Just a great return for Bitcoin. And this is the digital gold investment that investors can put a little money in, have it a store of value. That's what I do. I put a little bit of money. I've been putting a little bit of money in there, and I'm really happy I did so because it's really performed great. So go Bitcoin. I hope it continues to go. The big news is that it punched through 100,000. And I think that really means a lot. I think it may really signal that Bitcoin is now going to target 200,000 because we eclipsed $100,000. And it tends to do that. It tends to punch through it. It's really pulled back. It was up trading almost at $104,000 per coin. And it's pulled back to about $97,419. So overall, I'm a happy crypto investor, and it might be an opportunity to buy a little more because I am just more optimistic that we are headed to 200,000 on Bitcoin. It is good to see you, Shadow Guy. Thank you so much for joining, and thank you for the welcome back. I hope you're having a good week. And Mike, the dividend investor guy, how are you, sir? Your next target on Bitcoin is 250,000. I like your number more than mine. I think I'll go with your number instead. And I like 250,000. And we'll see how it gets there. I'm a little amazed that I got to 100,000, but it got there in quick time. I think the whole environment around crypto is looking very good. The administration that's going into office favors cryptocurrency, and the Federal Reserve chair actually phrased that Bitcoin is a digital gold. It's a store of value. That's big news because Bitcoin was this obscure investment that only, risk. It was a very risky investment, and only a few people would invest in. Now it's become mainstream enough for the Federal Reserve chairman to put it into conversations that he's having with reporters. To me, that's huge. That means the adoption rate is really high. The adoption rate internationally is doing great. So I'm really optimistic about Bitcoin in the future. I treat it as a small investment that's done just really, really well. Most of my net worth is in real estate. Second place is stocks, then bonds, and then crypto. So I hope Bitcoin keeps driving up, and we'll see how far it goes. So thanks so much for everybody joining. Sion Ken, good to see you. How are you, sir? Looks like TMDX. Not familiar with it. I got a couple of stocks that I wanted to jump into, but once I get through those, I'm going to take a look at that ticker. Then Mike, the dividend investor guy. I love to review it. Mike, can you refresh me? SNPS. Is that synopsis? Yeah, we could definitely take a look at that. Bitcoin competition to Fed. You know, what may happen is that the Federal Reserve has gold in its reserves, and there's some, if anything, just the thought is now more realistic that maybe the Fed is going to buy some Bitcoin and have it as part of its strategic reserve. We'll see. We'll see. It's certainly in the conversation now. We'll see what happens there. All right. So we had some earnings. We had earnings from DocuSign today after the market closed. Market really liked what DocuSign had to say, to the point of it rallying in after hours trading by more than 14%. This is, especially since the stock is up 82%. At one time, this I would put in the small cap category. I think it could still qualify as maybe a little bit of a larger small cap, but it's still only $17 billion in market cap. In the era of multi-trillion dollar valuations, that's a small cap to me. It is a software company, and it's a little less than $3 billion in revenue. And the reason it has a really nice valuation and you're paying more than 5 times revenue, maybe closer to 6, is because of its margins. And I will show that to you a little later. Its PE for the current year is excellent, 17, 23 forward PE. This company is growing at 8%, their top line revenue. And this is a very strong business for what they do. They do digital capture. If you bought a house or did a real estate transaction, you went through DocuSign. If you're signing documents electronically, chances are you're going through DocuSign. These guys are the market share leader. They are seeing some competition from Adobe, who's trying to go into their business, but so far so good. They continue to grow their business. They've been doing so well that price targets are below their current stock price by analysts. They think the stock is overpriced by 17.79%. I'll do my own valuation in a few minutes and share with you where I think the stock sits compared to the stock price. What's the value of the stock versus the current stock price? So we've got, those are the fundamentals there. Let's take a look at their earnings. So this is straight from their presentation from their earnings. And I like to look at the top line revenue, which tells me, do people like the product enough where more customers are using DocuSign and the current customers are using more of their services? And the answer is yes. They have good organic growth of 8%. And that's overall. Internationally, they're doing even better, which is good to see. Their billings have grown. This is what attracted me. I'm an investor in DocuSign. I've been an investor in DocuSign. But what I really like is gross margins that are really high. And there are few industries where gross margins are 80% or higher. DocuSign is one of those companies that gets to have gross margins that high. That's you can't get that in other industries. You look at the automotive industry, you'll never get anywhere close. You look at services business, never get that close. But these guys have a software that people want. It doesn't cost them a whole lot to operate the company, to sell one additional unit of their software. So they get to operate with very high margins. Those high margins then give the company a lot of free cash flow. That free cash flow, to me, improves the value of the company. DocuSign's a software company. Microsoft's a software company. Microsoft's over $3 trillion in value. There's lots of companies that are in the multiple hundreds of billions of dollars in market cap value that are software companies. So this is a small software company that I think has a lot of value. So their earnings were good. The market really liked what they saw from their top line growth. They also are reducing their cost. Their headcount went down by about 240 headcount. That's going to reduce their costs, make them a little leaner and a little more competitive. The other stuff that I saw here was a little bit too detailed. The cash flow was a little lower than I expected. I thought the cash flow is going to be a little higher, so I've adjusted my valuation based on the cash flow that they're reporting. So top line revenue, very happy with it. Maybe that's why the market really liked that 8% growth. The margins are excellent. These guys don't have any, or they have very little debt. Their balance sheet's really strong, and they guided quite well. So the DocuSign business is very healthy and strong. When we look at the valuation that I've put together for DocuSign, I'm going to discount the company by 8.5%. They're a smaller company. I want a higher rate of return. When I do that, and I updated the free cash flow that I expect, updating the forecast of free cash flow that I expect, I get about an 8% discount on the company based on the closing stock price. Now, that stock price, 83.68, is not going to be 83.68 in the morning. It's going to be 95.74. My Google Sheet does an automatic update, but it's on the actual trading price. It's not an after hours. So we know that it's going to be priced at a little bit of a premium tomorrow morning if the stock stays where it's at in the after hours. But we can see that I'm going to call it fairly priced. It's right around where it should be from a stock price versus its stock value. If you look at the free cash flow. Now, one area that I didn't update that we could update together here is let's take a look at the earnings per share forecast and then value the company based on earnings per share. 14 analysts covered the stock, and they believe the stock's priced 18% too expensive. And tomorrow, it'll be more like 30% because it's going to go up 14%. Now, one analyst does think very highly of the company, that the stock is really worth 108. Okay. And some analysts think, well, it's really overpriced. But on average, it's overpriced by 17%, according to analysts. They base it on earnings per share. And the earnings per share, these guys have a fiscal that ends January 31st. So we're around the corner of this company closing their year. Their year closes January 31st. So in about a month and a half, let's call it 2 months, they will have concluded their fiscal year. So I'm going to take 26, kind of looking into the future. They're going to expect it to grow their revenue by about 6% next fiscal year, and then 7.5. That looks good. Just steady growth. And earnings per share are expected to be $3.76. So $3.76. Update that. Look at that. When I blend the two based on today's closing price, I think the stock is fairly priced. It is on the button where it should be. So I own DocuSign, and I'm happy owning DocuSign. It's been a good stock for me. And let me show you how much of the stock that I own. So right now, before it trades tomorrow, I own, call it $35,000 of DocuSign. I like that position. It's a smaller cap company. I've got a good gain going. I think I'm going to continue to hold. I think the stock's a good one. It's actually a really good acquisition target. If you think about a larger software company can come in and acquire DocuSign and add their product to their list of products sold, and pick up that really good margin, pick up that really good free cash flow, and their balance sheet's really good. So DocuSign's having a good night. Very good. It's been one of those stocks that for a long time, DocuSign was really kind of left off to the side. The market just didn't really pay a whole lot of attention to it. And that's probably the wrong chart to show, but this kind of shows that, hey, it's bumped at $50 a share a couple of times. And geez, just very recently, as of August, if you would have bought it, you'd be up 68% just in 4 months. So really nice return over the 4 months. So it's really worked over the last 4 months. It's really worked over the last year, and it really provided a good opportunity for value investors that like software companies, that like high margin businesses. DocuSign was right there available to invest in. So that is DocuSign. Good to see that's working. A stock that is not working is Uber. And I should say Uber is a great business. But for some reason, the market said today we shall sell Uber off by 9.6%. And I continued to look for stories. What is the story that's causing investors to sell Uber? And Uber and Lyft stocks plunge as Google's Waymo brings driverless taxis to Miami. But the story that I read was Waymo is going to do that with a company that Uber has funded, which is Move. So it's kind of like Uber is kind of winning. So why? I get that robotaxi could be a threat to Uber, but I don't think Waymo intends on having a gigantic platform, or I should say, ride hailing business. I think soon they're going to continue to do partnerships and kind of share in the profits with an Uber and providing the technology to an Uber. I'm an Uber investor. I'm a Google Alphabet investor. So I'm an investor in Waymo. That's how I see it because I've been an investor in Google Alphabet for some time. I've known the company for a long time. And their approach is to build platforms and then have other companies use those platforms to then create businesses around them. And the Waymo robotaxi platform is exactly that. They can partner with Uber, Lyft, maybe even some metropolitan entities, and they could provide robotaxi with the Waymo technology. And then Uber sits back, has very good margins. They don't have to administer the day-to-day on what would be a consumer-facing business, which is robotaxi. We'll see how things play out. Maybe Waymo does want to keep the network and have the relationship with the consumer. Maybe. But in most cases, they like businesses where they're separated from the front line and dealing with the consumer, and they make lots of money. So I'm a buyer of Google Alphabet, and I'm a buyer of Uber. I probably bought about $1,300 of Uber, and I forgot how many shares today, but I really saw that as a drop that it was more noise than it was fact. When I look at Uber, it's a very well valued stock, meaning I think it's still discounted. So I am happy to pick up more shares of Uber. Like we just saw DocuSign. The market didn't think much of it 4 months ago, and then it rallied up 68%. I think the market's going to wake up at some point and say, whoa, what are we doing? Uber is worth a lot more. I'm not sure why my stock price is not updating. That's strange. Well, I'm using a Google product, by the way. I'm using Google Sheets. And this formula should be updating with the stock price is $65.23. Why is this not working? Let's give it a refresh and see if Google needs to wake this Google Sheet up somehow. Hey, here we go. That's all I needed. It just needed a little pick me up. But I really love their cash flows. I think they're growing real well. They have good margins. I think they're actually discounted quite a bit. This is Uber. So I think Uber is going to be worth a lot more in the future. And they have a gigantic network. When you think about the fact that more than 1 million people hail a ride every single day On Uber, 1 million, and it's growing. That's scale that it's going to be hard for others to replicate. I think Waymo's going to be better off just partnering with Uber. Hey, you got the riders. Let's put them on robo-taxis. Perfect. Everybody wins. Uber wins. Google Waymo wins. And Google Waymo becomes the dominant platform by partnering with Uber. So they are already partnering with Uber directly on 2 markets. I believe they're going to do it in Austin and Atlanta. They're going to be Uber cars. You can fetch a robo-taxi, and it would be the Waymo technology. So it was an opportunity, I thought, to pick up some shares of Uber and increase the amount that I've got invested in Uber. I have a lot riding on Uber, got $73,000 of current stock value there. I'd like to build it up to 100,000. That's how much I think of Uber, and we'll see what happens. Another stock that announced today, and it's a really great boring stock. I love boring stocks that make money because the money spends the same. Whether you're in a really cool company that grows and makes you money, or you're in the grocery business. And Kroger has been getting it done over the 1 year, up almost 36%, and you get paid a 2% dividend. So you're up, call it 38%. Boring, but profitable. And over the last 5 years, it's been boring, but profitable. Up 119%. Add the dividend, you're probably up well over 130%. So I like Kroger. It's one of my holdings. They announced today before the market opened. The market was trading the stock down a little bit, and then it realized that, hey, you know what? For whatever reason, it started to pick up the stock price. So it's good to see Kroger is up. I'm just holding my shares of Kroger. I own a good amount, and I'm just happy to own Kroger. It's my single staple stock. It's a food company. I don't own any other consumer staple stocks, just Kroger, and happy to be an owner. I rarely am concerned about the Kroger business. It's a really well-run business. They may not be in the most exciting industry that is out there, but I can tell you their management team is one of the best. And their partnership with stockholders, one of the best. If you look at their earnings releases, they go out of their way to really inform stockholders. They really communicate really well with stockholders, which is the direct opposite to what like Intel had been doing. And I know they had lots of problems, but they would surprise investors quite a bit. And other companies do that. And that is not good. At the end of the day, management at a company exists to maximize shareholder value. We're the shareholders. We're the boss. And it's not an ego thing. It's just we put our hard-earned money into these investments. Management works for us. And Kroger has one of the exceptional management teams that I've observed that really partner with the investor. So that was Kroger. All right, you guys are at it in the chat, and I appreciate all these comments. Let me try to catch up. And I already noted that symbol. We'll take a look at that. Hyper Wizard. Acre Solutions. So yeah, let's take a look at it. So that's Acre Solutions. That's AKSO. And it's on the OSL. Is that Oslo? Is that Norway? We'll take a look at that, Hyper Wizard. Thanks for joining. Cyan Kang. Tesla's Robotaxi. That could be the story. That could definitely be a story. Waymo will be disrupted. We'll see. We'll see. I think that Tesla talks a mean game, don't they? They talk a mean game. But it's easy to count how many robo-taxis they have in service. None. Now, Waymo, they have I think tens of thousands, and they're operating in like 4 major cities. They've been doing it for 10 years, operating in service for 10 years. So, you know, let's see how things play out. I know that Tesla is a pretty interesting outfit. I hate their margins. I don't think they make a whole lot of money, and I don't think they make a lot of cash flow, but they certainly got electric vehicles right. And we'll see if they're competitive in robo taxis, or if they take a few shortcuts and their robo taxis cause really bad collisions. That would be really detrimental to them. Waymo's been really careful. They've been at it for like 15 years. It's not the first time. In addition to Waymo, Amazon has their robo taxi service, Zoox, and they're going to go operational. Forgot the city, but they're Las Vegas. They're putting their robo taxi in service in Las Vegas. So Tesla's got a lot of catching up to do. They're probably going to join the market when there's at least two very large, very strong competitors. Amazon, which is more than double their market cap. Google Alphabet, more than double their market cap, that have very deep pockets that no matter what Tesla brings to the table, they're going to be behind for at least a couple of years, if not for the next 5-10 years. So it'll be an interesting story to follow. We'll see how it plays out. Mike. Yeah, I didn't understand the sell-off of Uber, but you know what? I do my own analysis. I invest my hard-earned money, and I will gladly buy more Uber shares tomorrow if the stock trades down. We'll see what happens. No, we're back to Tesla. I'm not buying that one. Maybe. We'll see. Yeah, I use Uber Eats as well, especially when I'm on the road. I started to do that versus when I'm in another city. I travel, and sometimes I get to a city, I'm a little tired, and I don't want to like guess at where to eat. So I look on Uber Eats and have it delivered, and I'm good to go. Get something that I want to eat. I want to eat healthy because it's very easy to eat unhealthy. But if I put some thought into it, I can get something healthy on Uber Eats. Yeah. So, Mike, there's been a few occasions where we do the same thing, which is great, man. Good to be in the same community with you. And I hope we both count big winnings in the future. All right, Carlos, thanks for joining. So SFM has been an awesome stock. Let's take a look at it, because that's been a high growth stock within grocery. I was a little shy of it because I own Kroger, but it's done great. So let's take a look at it. There might be a lesson there. Cool. Talking robo taxis. That's going to be a big business. All right. Yeah, it's all everybody's opinion, and just keep bringing them, Cyan Ken. If you completely disagree with me, please bring it. I will not take it the wrong way. Nobody should ever take it the wrong way. We invest our hard-earned money. We should state our opinion. We should say, hey, this is how I see it. This is how I want to invest. And it'll be respected. If anything, I like opinions that are completely opposite to mine, because it makes me check my homework. Like, hey, am I not seeing everything right? I got to double check, man, because I don't want to lose money. So keep bringing it. All right. So we're on to the next stock. Let's take a look at, I think Mike wanted to see SNPS. Synopsys. I've heard the name, but I can't remember what these guys do. Synopsys provides electronic design automation software products used to design and test integrated circuits. It operates in 3 segments: design automation, design IP, design integrity. All right. So software in the semiconductor space. So they announced yesterday, man, their stock sold off. What is the deal? Semiconductors are red hot, super hot, hottest industry, period, last 2 years. Just ask NVIDIA. Now, when we look at their financials, and we have the latest and greatest updated thanks to our friends at Stock Analysis. I get nothing from Stock Analysis, but it's just the platform that is my favorite. I pay for my subscription, and really nice people over there. Every time I ask them for something, ask a question, I get a response very quickly, by the way. I don't know if you've ever asked them for something. So their growth is slowing down a bit. So we got really nice growth in 22, 23. It was good, but slowing down. 24, it slowed down. So it looks like the slowdown is kind of sticking. Let's look at the quarterly. Quarterly saying, yeah, they really did slow down. It was slowing down to 12% the previous quarter, but then 2.3%. That is interesting. Now let's take a look at their profitability. This might be a good investment. This is a $79 billion market cap. Last year, it's down 3%. Over the last 5 years, wow, look at that, 280. Go Synopsys. All right. This is a good one to value. I haven't valued this one here. So this one might be one that we jump into a valuation. Let me take a look. So PE is a little high. If you're going to have a PE this high, you better be growing 20%. Their revenue is $6 billion. Okay. It's not the highest revenue on earth. Our friends over at Kroger, $150 billion in revenue. They're growing at like 2%, which is like 3 billion. They grow half the size of Synopsys. Now, Kroger doesn't get the valuation that our friends at Synopsys get. Kroger's 150 billion in revenue, and their market cap's like 50 billion. So if you're going to be priced as a growth company, you need to grow. You don't grow, you go down. That's just the rule. Not my rule. It's the rule of the stock market. Analysts think, hey, it's discounted by 25%. It's a strong buy. All right. Let me take a high level flyover and see if I'm agreeing, and maybe we jump into a full valuation. Now, I do love this green on the screen, by the way. This business has been up, up, up. They went from 3 billion in 2018. They're north of 6 billion in the trailing 12 months, which is roughly 6-7 years later. Excellent work. Excellent work building this business, getting it to that level. Cash flow hasn't grown with the business quite as nicely as I would have liked, but it's trailing 12 months, 1.2, call it 1.3 billion. Okay. Look at these margins. Beautiful number of 81%. Beautiful number. I'm going to toast that number because I need to drink something. All right. Great gross margins. Love their gross margins. But what the heck is causing their growth to stop? That is a homework item, because I would not be comfortable investing in a growth company that isn't growing. Because what's going to happen is, if they stay on a growth projection of 2%, for a year, 2 years, this stock is going to tumble. It's just not going to be all that great. A growth stock should be growing like this. But you can see, as the law of big numbers, right? As these numbers get bigger, it gets really hard to compare against them. And this number, Q4 24, had to compare against a $1.6 billion number, which grew nicely at 24%. And yeah, it was a great quarter. Stock really rallied back then. But a year later, you have to compare against that number. And that's where it really gets hard. And it's going to stay hard because you're going to have compares that are pretty tough. Okay. So based on the fact that they're not growing, their cash flow at best supports, in my humble opinion, maybe a $35 billion market cap. This is not going anywhere in my book. They're highly overpriced. I think this stock could be worth 50 billion very quickly. And it looks like the market is really pumping the brakes on this stock. It doesn't know what it's doing. The big story out there is AI is humongous. It's driving a lot of semiconductor sales, most definitely NVIDIA. NVIDIA is doing fantastic. The other semiconductor companies are doing okay. I own Qualcomm. I track Broadcom. And I can tell you that Broadcom's doing okay. They're not doing great. They're doing okay. NVIDIA is doing incredibly well. That's the one company. So Synopsys may be feeling that, hey, maybe the semiconductor space isn't doing as great as we thought. If you remember, our friends at ASML announced their earnings. ASML is the company that makes those big machines that you actually make semiconductors in. And when they announced, I mean, look at this stock. Whew, it's been coming down. It's still up 3%. But at one point, it was much higher. What's going on with ASML? And the reason I bring it up is that ASML is in the same industry as Synopsys. They're down 35% since July 10th. So I'm going to guesstimate that's about 5 months. And the market's really selling off ASML because ASML is saying, our backlog is not all that great. You know, semiconductor companies are not ordering our big machines that produce semiconductors. Now we're dealing with a company that helps the semiconductor companies design chips. And they're seeing the same slowdown in semiconductors. So the sell-off in ASML may be a preview, or it's maybe taking place at Synopsys. Today being an example of what could happen to Synopsys. It could continue to sell off. So this one here is a complete pass for me. If they turn things around, maybe they can get fairly valued at $80 billion, but I just think that they're worth maybe half that amount. And we'll see what the market says over time. Thanks for asking, Mike. Hopefully you find that analysis and comments, you find them interesting. All right, so let's keep tracking. We're going to go to TMDX. That's Transmedics Groups. Transmedic Group is a commercial stage medical technology company. And I think you had another comment in here that I'm going to read in a minute. Engages in transforming organ transplant therapy for end-stage organ failure patients in the United States and internationally. The company offers Organ Care System, a portable organ perfusion optimization and monitoring system that utilizes its proprietary and customized technology to replicate near physiologic conditions for donor organs outside the human body. Very interesting. We're going to look at their financials in a bit. Down 8%. They announced October 28th. Now, there was a sell-off in healthcare today. I was noticing that as a healthcare. Now, I forgot who asked about this, but you had an extra comment in there. I want to make sure I read. So, Scion Ken, what do you think about TMDX? So, TMDX has a patent on organ storage technology. They also have tech for heart reanimation for transplant. All right. So we have a company that's a $2 billion company, small cap. Revenue is $400 million. So you're paying 5 times revenue. They do have a PE, so they're profitable. Let's see how they're growing. We'll see if they're priced correctly. Analysts think it's 89% discounted. Woohoo! Let's take a look. So it's done great over 5 years. Over the 1 year, it's down 11%. Looked like it had a high of 176. Wow, it's less than a third of its all-time high, which happened very recently. Man, this one is a bit on a nosedive. So this thing had a high on August 27th, and it's down 62% in 4 months. Actually, less than 4 months, more like 3.5 months. Wow. There's news on the street that these guys are having to deal with, I'm sure. Now, the one thing I would say is what's interesting is that just this in the last 12 months, these guys really ran up 147% over the course of 5 months. And then they have crashed down 62% over the course of 3.5 months. Wow. So if you're that lucky investor and you bought here and sold here, and now you can rebuy here, congratulations. If you're the investor that bought whenever here and you're still here, you're probably feeling like, holy smokes, that was a roller coaster. So let's take a look at the financials, see what we got. See what we got with this company. Wow, look at these growth numbers. Wow. I say wow when I see 3 digits, right? 117%. Beautiful. Now their growth did slow down. We compare Q3 compared to Q3 in 2023. That's 66 million. Okay. So they're growing at 63%. That's a very good growth rate. Okay. Now, why is the market like flipping out to the negative? Let's take a look at free cash flows and margins. So they are cash negative. We're going to look at the statement of cash flows next. Margins are decent, 56%, very decent. Okay. So we have high growth, decent margins, and they are profitable on earnings per share. Now, if they have a lot of equipment and so forth, they're probably going to have a lot of capital expense, which is what is burning all that cash. So when we look at cash, and I looked at the quarterly, so I'm going to look at cash flow for the annual. So free cash flow negative 120. And the reason for it is likely going to be CapEx. So capital expenditure, in my mind, is how much money you have to put back into the business. That software business we saw with DocuSign, they don't have to put much back into the business. It's software. You write it once, you sell it to 1 million customers. You didn't have to write it 1 million times. You didn't have to rebuild the factory. You don't have to do the maintenance on a giant tractor. No, you just sell software. It's pretty easy. You sell it over the internet. These guys are actually having to maintain equipment that is mission critical. You have organs that are going to be kept alive with this equipment. So these capital expenditures have to happen, and it's pretty expensive to keep things running. What is interesting is in previous years, the CapEx wasn't too bad, but maybe the equipment's getting older, or they're just not sure where this CapEx spend is coming from, but it is burning all their cash. All right, so I don't like the cash flow. Let's look at their balance sheet. So they have EBITDA of 51 million, total debt of 518, cash of 330. So they have 188. So they have about 3.5 times EBITDA, which is fine. I don't see that as a big. I would prefer for them to be under 3, but to be 3.5, that's okay. Balance sheet's not a red flag. Big red flag is all that CapEx. Why the heck are they spending so much on CapEx? I like their cash flow. I like their revenue growth. Looks great. But what's burning all that cash? So I would leave that homework item with you. Is that going to be temporary? They're just going to do it a couple of years and then be done with it? Or is it just going to be, hey, that's the nature of their business and they're going to have to spend that kind of cash? Based on that, I can't really give you a valuation. You got negative cash. I can't tell you what the company's worth. They have to produce cash in order for me, free cash, in order for me to say, hey, I think they're worth 5 billion, 1 billion. At this point, with negative cash flow, I can't go any further. So that's where I'm at with this one. That negative cash may be scaring off investors and they're selling off. There was a decrease in growth, but the growth is still good at 63%. And maybe that CapEx is coming out of a story within the company. If you study their earnings releases and study the business, maybe there's something there that is something that it's a new added cost that is really going to make the business less desirable than we first thought. So thanks for asking. This is an interesting company. Hopefully they help a lot of people. They make it. And thanks for asking. All right. So let's take a look at AKSO. Aker Solutions in Norway. Aker Solutions provides solutions, product systems, and services to the oil and gas industry in Norway, Brazil, UK, Malaysia, Angola, Brunei, Canada, India, and internationally. So Norway does have a lot of oil, and of these countries, I think Brunei is in South America. They have a fair amount of oil, and I'm not sure about. I know Canada has a lot of oil, and so that's interesting. This is a 16.75 billion market cap company. Revenue is 42 billion. Wow, that is a lot of revenue. So they do solutions, product systems, and services. Okay. Over the 1 year, they're down 11%. Over the 5 year, up 58%. Very respectable. They pay a nice dividend, 5.76. You combine this dividend with this 5-year chart, you're up 80%, 90%. And I think that's a very good return. This is a small, maybe small, medium cap. When we look at their revenue growth, they have been losing revenue. Now, what's going on here? How come I'm seeing growth here? Like the numbers keep getting bigger. Why is this number wrong here? So 12. The company keeps expanding. I guess at one point they were 37. So it's been a little bit of up and down. And the oil industry tends to be that way. They have booms based on oil price, and then they have moments that are settling down. This company here is, 42 billion. Free cash flow of $1 billion. Free cash flow is down over the trailing 12 months. Previous years, it was really nice. But now it's down to $1 billion. Okay. Gross margins are a little low. They probably do a lot of services for the oil industry. If they were purely a software company, like we showed DocuSign, they'd be 80% margins. But since they do a lot of services, have to hire people to do the services, they are not as profitable. So, all right. So, based on their free cash flow, I mean, I would put this company in, let me look at their balance sheet, see how much debt they're carrying. So, the EBITDA is 1.2 billion. They have more cash than debt. Very good. So, they actually have a surplus of 10 billion. Okay. So, I have 10 billion of cash. This is, what currency are we dealing with? Okay. This is NOC. Okay. What's conversion? So almost a 10th. So a 10th. Okay. So So this is more of like a $1.5 billion market cap US dollars. And then this is more in the neighborhood of 4 billion in revenue US dollars. Still good. And everything else being the same. This is an interesting company because you have about 10 billion NOC currency. So you're really getting the company, you're paying 6.75 billion, and they have cash flow of $1 billion. In previous years, it was up to 4 billion. So this actually is a pretty good idea. They pay a good dividend, they produce cash, they have more cash on the balance sheet than debt. This is a pretty good idea, pretty good investment idea. So I would actually say this is a good one. I don't know what you think it's worth, but I'm seeing that this thing's going to be worth a lot more. They've done well over the last 5 years, but they've had a sell-off. If we see a rise in oil prices, these guys are going to be rocking, and these guys are going to return a good return for investors. So I'm actually going to put this guy on my to-do list to do a full valuation. I think overall it's discounted. It's a foreign stock to a U.S. investor, but that's not a bad thing. I've got like 90+% of my stocks in the U.S. This could be a nice addition. At the beginning of the year, I looked to reduce my position in Chevron, and I wanted to get into some smaller caps in the oil energy industry. This one might be a good one to add. So this is a good one. Thanks for putting it out there. So the dividend caused, people to sell off. Interesting. Yeah, that happens. And then I heard TAM for TMDX is considered limited. Could be. Yeah, because I mean you're doing with organs. Yeah, definitely. That CapEx, right? There's a reason why like free cash flow is a measure that a lot of value investors use it because it really does show you the value of the business, right? If you make like those software companies, you make $1 million of revenue and you get to keep more than 80% of that revenue as a gross margin. And as it trickles down to the cash flow, I think that company produced 20-30% free cash flow on their top line revenue. Those are just tremendous metrics. If you go to another industry, you're lucky to get out with free cash flow. The CapEx, it is, in my mind, you having to, rebuild the business, rebuild the factory, rebuild the machines. And if it costs more money to rebuild the machines than it is to charge your customer for the revenue, it's not worth it to own that business. It's better to go buy a business that just is really lucrative, like a software company, like other businesses like Meta. They do social apps. They don't have to put a bunch of money back into their business. They get to get all that cash and buy other businesses like Instagram or other businesses like WhatsApp, continue to get bigger and more powerful and more valuable. All right, so that was Acre Solutions. Now we're down to SFM. These guys were just killing it. Sprouts. Look at this. Oh my God. 234. Incredible. And this is a small company compared to Kroger. You got 7.42 billion in revenue, market cap 15 billion. Again, the ratio, if you compare them to Kroger, Kroger's $150 billion company. It's like 50 billion in market cap. So very different businesses. And it's because these guys are growing. Their growth rate is very good. Why didn't I invest in Sprouts? Yes, this is good growth, but it's not like incredible growth. It's just good growth. They are accelerating, and I believe they're doing it because they're opening new stores. And that's good for them. Good for them. Let's take a look at some other metrics. Free cash flow, they do produce free cash flow. If I took this cash flow based on their 10 to 15% growth rate, I'd probably get to a valuation of 30 billion. No, excuse me, 3 billion to 4 billion. And they're much higher than that. So I always had a hard time valuing this company because they don't produce a ton of free cash. And you can see that in 23, they were actually negative cash. Now, when we look at their, look at their margins, right? 38%, 37%. That's not bad. I think that's better than Kroger. So margins are pretty good. They sell a premium product in their stores. Their stores tend to have a smaller footprint than a Kroger or a Walmart or a Costco. Those are very good margins. Let's take a look at their balance sheet. EBITDA, 608 million. They have about 1.3 billion of debt, so 2 times EBITDA. Very good. Business looks good. Yeah, this one here, man, why didn't I buy this stock? Look at that stock. I've been aware of this company. I just didn't believe that a new grocery store company was going to do this well. But here I am acknowledging that I was wrong. This stock really, really did work. It's at 234. And I don't know what to tell you. I've been wrong on this stock at every point. And this one was a humongous winner. Is it a good buy going forward? I'm not the right person to tell you. I would say that it's worth more like 5 billion at best. And obviously the market thinks, no, it's worth 15 billion. And this is why it's traded up. So even analysts think it's a little expensive, but not to the level that I think it's expensive. I think it's really expensive, but I've been wrong on Sprouts for a long time. So I humbly just say that I just don't get Sprouts. Everybody else does, and I don't. I'm going to stick to software companies and technology companies and semiconductor companies because on those I tend to do okay, except for Palantir. I've had Palantir completely wrong and acknowledge that. So Sprouts, incredible rise in that stock. Hopefully some of you own it and have made a lot of money on it. All right, so we made it through the list. That was Sprouts. Very good list. Thanks for showing up and asking about those companies. I appreciate it. I think that's all we have for today. It looks like we're going to trade again tomorrow, and we'll see where the market trades. I don't think the futures is going to show us. Oh, it looks like the futures are pointed up, but it's so early. It's too soon to tell. We'll see if we trade up. Overall, it's been a very good December so far. It's been a really good, 4 days of trading for me. I'm up nicely. I had a phenomenal November, and I'm having a great year. So let's keep it going. We'll see what happens early next year. I'll be very, very curious to see what happens. I wouldn't be surprised if we have a correction, but at this point, what if we just keep going up? We'll see. All right, everybody. Mr. 123 Cheetah, thanks for joining in. I appreciate it. Thanks for tuning in, everybody. I appreciate it. And I'll probably be back sometime next week, but this will be the stream for the week. For all the people that are members of the community, we'll have the investor call on Saturday where we do the workshop and just do maybe some workshopping around some skills around investing. And then on Sunday, we'll talk about stocks in the investor call again. If you want to be a part of that call, look at the details in the video and you can get signed up. Everybody have a terrific evening. Thanks for tuning in. Good luck with your investments.